Hi, and welcome to Chapter 5. Today we're going to talk about cash and liquid asset management. So, things that we're going to cover in this chapter: managing your cash, understanding why you need liquid assets, automating your savings, choosing among different types of financial institutions to provide cash management services, compare various cash management alternatives, compare rates on different liquid investment alternatives, establish and how the best way to use a checking account, and how to transfer funds electronically and understand how electronic fund transfers work. So first, let's talk about what is a liquid asset and why is that a critical piece for personal finance. Well, liquid assets are assets that can be turned to cash very quickly. So without liquid funds, that you may not have enough money to cover your current expenses or unexpected expenses. Because the idea here is you have your longer term investments, your stocks, your bonds, your real estate. You don't want to have to ever sell any of that before you're ready. So having enough liquid funds to meet your current expenses is a way of preventing you from having to sell certain other assets prematurely, so you don't become insolvent. Um, So you want to manage your liquid funds effectively, meaning that you want to have the least amount of fees and the most amount of interest or returns on your money, as well as the most convenient location for your money. So the most liquid asset you could have would be cash in your house. Absolutely, the most liquid is already cash and it's in your house. So I wouldn't say to keep thousands of dollars in your house, but I would say that you want to keep some cash in your house in case you suddenly need to pay for something in cash. For example, maybe someone's coming over to repair something in your house, or is coming, or you need cash to buy something that could be from a restaurant or service that's cash only, or maybe there's your bank has as maintenance going on, you can't access your accounts for the ATMs to get your money temporarily. I mean, there could be many, you know, benefits to having some cash in the house, and that's the most liquid asset you can ever have. But cash in the house doesn't earn any interest, so it's probably and it's not flexible in terms of paying for things electronically. Now, cash management is going to be looking at all of your liquid cash, your near-term cash assets, and trying to figure out where's the best place. How much should I keep in liquid assets and where should it be? Because remember, other assets that are less liquid, like real estate, generally have better returns. So that's why you don't want to have all your money in cash or liquid assets. So you have to choose from different alternatives when managing your choices. And there's a lot of choices on the liquid side. Now, the the thing that makes them liquid is how quickly you can turn them into cash. So having a savings account and being able to go to an ATM means you can instantly move your money from a savings account into cash in your hands. Very liquid. Um, Typically, liquid assets should be in a very low risk type of an account where there's no penalties for withdrawing the money. Now, having savings, automated savings, this is something I highly recommend. So when you get a job, you're probably offered direct deposit. And that is something you should always take, direct deposit, and have it directly deposit into your savings account. Some employers will give you the option to direct deposit into two different accounts. You might opt to put 20% of your pay into your savings account and the 75% of your pay into your checking account. That way you're always paying yourself your savings first out of every paycheck, and that can accumulate without any effort on your part. And then you just have to budget yourself to live on the other 75% of your income. So uh, this is automatic savings is should be thought of as long-term savings, and this way you're less likely to spend it. And the earlier you start to save, the easier it is to achieve your goals through what we learned in Chapter 3, compounding interest and time value of money. So you definitely want to pay yourself first and put it into a savings account. Later, when the saving account starts to accumulate, this money could be electronically transferred to a brokerage account, and it could be invested in stocks and bonds or other types of investments to get a bigger return. So you have to determine, I mean, we'll talk more about budgets later, but you'll have to determine what your savings rate can be. So you want to be, I would say, a good goal for a savings rate is somewhere between 10 and 20% of your total income. So saving 20% or 25%, even better, if you check every week, is a good way of having an automated savings where you just get used to that not being in your checking account, and then you're just limiting yourself to spending what's available in your checking account. Now, when we talk about financial institutions, banks or credit unions, or what we call deposit type financial institutions, are what's going to provide traditional checking and savings accounts. So we'll have, they might be called commercial banks or savings banks. They're pretty much the same thing. You know, your Chase, your Citibank. Credit unions are more of a local type of bank that um, you could utilize. So certainly, as a student, you generally have access to a lot of credit unions, and the credit union is better because, and we'll talk more about this later, but a credit union is basically better because think of a credit union as a member of the credit union, you're going to share in the profits of the credit union. So credit union is non-for-profit. So any money they do make, they funnel back usually as enhanced interest on your savings accounts. Where commercial banks are really focused on a fee structure to get you to pay additional fees to the bank so they can make money off you. So the two ways a bank makes money is one, you deposit the savings and then they can take your savings and lend it out to other people at a higher rate than they pay you for your savings. Or they can facilitate methods of other services they can provide you to enhance their revenues, such as fees, or there could be penalties for overdraft or insufficient funds in your account. So these banks are always looking a way to make more money from you. So if they're looking, so if part of their perspective is to make money from you, they're probably going to take their goal is to figure out ways to get more of your money in their pockets. That's why credit unions are different. They don't really look to um, make money off of you. They look more like a non-for-profit service where they're trying to give you as many services as possible while minimizing the fees. And generally, you can get lower rates of interest for car loans and mortgages through a credit union than a commercial bank. So, uh, so the commercial banks, they're going to have probably a bigger network of banks. So if you look at a Chase or a Citibank, or a TD Bank, they're all across the country and sometimes across the world. So the the size of these commercial banks do make it a little bit more of an advantage because you can go anywhere in the country and find a Chase Bank or a Citibank. So it makes accessing the network of ATMs a little bit more beneficial. Plus, these big commercial banks, they have the widest variety of financial services to offer you, not just the plain old checking and savings accounts, but they also have things like credit cards, safety deposit boxes, maybe financial consulting, mortgages. So there's a lot that they can offer, including local branches that you can go down to and talk to a not just a teller that could actually help you with your transactions, but they usually have additional people there that can help you make other financial decisions, such as borrowing monies for a loan, personal loan, business loan, mortgage, or auto loan. Now, a savings and loan association, which is sometimes called the S&L or a thrifts, this is very similar to a commercial bank, but they're a little bit more focused on auto loans, mortgages to depositors. So these are a I would say they're very similar to commercial banks, but they're just a little bit more focused on Where commercial banks do have a lot of services also for businesses, savings and loans are mostly about helping individuals with personal finance, with creating and offering loans to individuals, and also helping individuals um, save. So the savings loans may typically pay more interest on the savings accounts than a commercial bank. So the savings banks, which are, I always think that they're pretty similar to the savings and loan banks, but the savings banks are, you know, primarily purpose has been focused on providing mortgage funds to their depositors. Now, and these just the savings banks generally won't have a big business component to them, where the commercial banks do. Now, the credit union, which I was talking about before, credit unions are generally organized by churches, schools, universities, labor unions, some corporations, and they used to be open only to members of those organizations. But now some laws have been passed, and everybody's able to join a credit union, no matter what organizations they belong to. Now, credit unions have a tax exempt status, so they're non for profits, which means that since they don't pay taxes and they're not necessarily trying to achieve a huge profit for shareholders, they're going to put more of those of the profits back into paying higher interest rates to their credit members and having lower fees overall for services and just more favorable rates on auto loans and mortgages than a commercial bank. So if you think about it, the if you're looking to get the most service for your money and the most interest for your money, credit unions are probably the best bet or the smartest financial decision as far as doing all your banking. Now, you don't hear too much about credit unions because they don't advertise as much as a Chase or a Citibank does. And because they're low on advertising, that means they're spending less to operate and they can give more to their members, is another benefit. Now, there are non-deposit type financial institutions such as mutual fund companies, brokerage firms, insurance companies, and they can offer similar services that are offered by banks. For example, it's not uncommon for a brokerage firm like Fidelity or Charles Schwab to also offer you an account that's like a checking account where they can give you uh, a checking account with checks, debit cards, credit cards. So the lines are a little blurred between the financial institutions because wherever they can make some extra money, they'll move into and they'll start competing with each other on some similar products. But generally, the brokerage firms and mutual funds can offer services that are not always offered by banks, such as being able to buy and sell stocks and bonds. Now, let's talk about mutual funds. So mutual funds are a separate company and they can take investments or funds directly from investors to invest in pools of money that invest in collections of stocks or bonds. And these are generally, most mutual funds are professionally managed that pay dividends or interest on their stocks and bonds to investors. And hopefully, over time, will pay you a much higher rate of return than a savings account. The risk is if the market goes down, typically these mutual fund values go down too. So there can be years where you lose money on your mutual fund. So not every year is a year you're going to be making a lot of money with the mutual fund. So it is riskier. Now, stock brokerage firms like Fidelity, like Charles Schwab, like E-Trade, um, like Robinhood, these are firms that are going to deal more directly with investments such as stocks and options. And they can also sell mutual funds. Now, they have the stock brokerages like Fidelity and Charles Schwab, which are the two biggest discount brokerages. They offer a lot of cash management tools, including financial counseling, credit cards, money market accounts. We'll talk more about that later. So they are in direct competition for your savings dollars as traditional banks are. Now, an important type of banking that you're going to be working with or looking at is online banking. So there are some banks that are completely online. They have no brick and mortar, no place to visit. So these online banks can offer you higher rates of interest and lower fees because they have no operational costs associated with physical retail locations. Now, all banks are going to have some sort of online access where you can check your balances, transfer funds, pay bills, um, view your statements. Um, and typically, if it's the online banking, it's not only can access it through the internet, through your computer, you can always, usually it comes with an app as well, where you can do all these things through an app as well as in the bank. Now, it's just very convenient. It gives you better access to your funds. You can transfer funds from your bank account to somebody else easily. Like Chase works with Zelle. Many other financial institutions will have a mechanism where you can transfer funds between members of that bank or members between other banks. Um, so for many of you in this day and age, we're all comfortable with this, this idea of online banking. So the advantages of online banking would be that, you if you do all of, and this is true for most brokerages are are fully online as well, where there's almost no reason to ever go in person to a bank or a brokerage anymore. And what's great about having all of your information digitally is that it's easy to import it into, say, TurboTax. So when you do your year-end uh, taxes, which we talked about in the previous chapter, you could download all your transactions from your broker directly into TurboTax, and then it will sort and correctly position all of your purchases and sales, your capital gains, your capital losses, your dividends, and make all the appropriate decisions and organize your tax reporting easily. And you can also download this information to personal finance programs like Mint.com, Quicken. With these, which help to organize and bring all your financial information together in one website. Now, if you use a website to organize all your financial information, it can be a little risky because they're going to need access to your accounts. So you typically have to um, log in with a username and password and download, or they automatically grab this information from the other accounts to put it all in one place. All your credit cards, your banking information, your brokerages, all in one website or app. The problem is, who's running this app? What's their security? I mean, it could put you at enhanced risk. So this is a warning if you use some of these third-party programs that can connect to your financial accounts. I think that much of this work you could do yourself directly with an Excel spreadsheet program. Now, you can't beat the convenience of online banking for tracking your accounts, paying your bills, getting up to minute credit card activity. I know with my iPhone, whenever my cards are all loaded into my wallet on my iPhone, and whenever I make a transaction or my card is charged, I get a notification. I can usually go in through the apps of the individual banks or credit cards and pay my bills directly, and they'll go from, I can pay my American Express bill on the American Express app, and it'll be linked up to my bank account, so it could go and automatically withdraw the money from my bank account. Or I could set up even better automatic payments. So I do recommend this for credit cards, to have all your credit cards set up on an automatic month minimum payment, and have your bills set up as automatic payments as well. So that way, at the end of the month, you don't have to actually write out any checks, remember to pay anything. Everything is automatically deducted from your checking account. You just have to make sure that your checking account has enough money in it that it's never going to be in a situation where it's run overdraft. Now, so the it's just a very effective and efficient way to manage your multiple accounts, um, including your retirement accounts. So I know I have Fidelity as a broker, and in my brokerage in Fidelity, I have multiple accounts in there, from my individual brokerage account, my IRA account, my retirement account is in there. So it's just a good way to organize everything in one area to get a quick look at how I'm financially doing. Now, and a lot of these websites are also always for free, provide you stock quotes, rates on loans, and just other ways of financial management to help you guide you through your financial decisions. Now, disadvantages of online and mobile banking is, the setup time, or what they're calling here the startup time. So it takes some time to register and set up all your bank and mobile accounts and link them up. And this is just, time consuming in the beginning because you have to set your username, your passwords, connect your credit cards to your bank account, set up your automatic payments. It does take some time to get everything organized. And uh, since you're probably going to use a multitude of different websites, every credit card has their own website, every bank has their own website. There's a lot of navigating and learning to do of how these different sites work. Although they're usually pretty similar, they all kind of have different tools and techniques and menu paths to get to. And then it's also a matter of feeling comfortable with having um, all your money accessible through logins and passwords. So you want to make sure that you don't use the same password or the same login name for any of your accounts. Keep all the accounts separate login names and passwords. Maybe keep a master password spreadsheet or paper version so you don't forget your passwords. Um, and the only other disadvantage is that customer service may be a little bit slower or poorer because with the online services, a lot of them don't have a direct person you can speak to. Sometimes you have to email or text and wait for a response. Where if you go to a bank directly, there's a person there you can directly talk to. Right. So now, what should you look for in a financial institution? Um, well, I would say a couple. There's a few things I'm going to talk about. One thing that's important too is the location of these financial institutions. If you're going for a bank, it's nice to choose a bank or a credit union that's closest to where you live because that really makes it easier to do any type of transactions that you might still have to do in person. Like there's very few these days. You can even cash a check on your phone. It's the only reason to go to a bank now is if you want to withdraw money or maybe you want to get some foreign currency or talk about other financial investments possibly or apply for a loan, but most everything else can be done online. So in that case, you would generally I work with two banks. I'll have a credit union that is relatively close to where I live, and then I'll have a bigger financial bank like a Chase that might not be so accessible as far as where I'm living, but more accessible across the country and have a lot more online services they can provide. But you really have to think about what financial institution is going to match your specific needs. Um, and you want to think about how comfortable are you with these particular financial institutions. So you should always look in what is their, how safe are they, as far as, are there any guarantees that your money's insured from the government does insure savings accounts, but only up to a certain amount. Is the financial institution itself very sound? They're likely to go bankrupt, which banks, believe it or not, do go out of business quite frequently. Or so you picking some of the larger institutions generally may be a little bit safer from smaller regional banks. And what are the costs associated with the services they're going to provide you? What are there fees in their checking account? Are there any hidden fees? So you have to be careful, especially if you have a credit card with a bank. There could be a lot of overdraft or late payment fees. You just want to make sure that you understand what they can charge you with. In some cases, with Bank of America, if you had a bank account with them a number of years ago, and say your checking account went to zero, and you made 5 purchases: back of gum, some gasoline, some food at the store, some movie theater tickets, what have you. The bank is not going to, in the past, the bank wouldn't alert you that you were overdraft, and then they would charge you a $35 fee for every transaction you made, almost hoping you're going to make more transactions so they could rack up the fees against you. Um, President Obama passed a law and created a new, financial protection division that made it more difficult for companies to charge you these excessive overdraft fees. Um, but you can see if the bank can try and get away with it, they will try to pile up the fees on you. So you want to be careful and know uh, that you manage your accounts properly in a way that you don't get charged fees that you shouldn't have to really, uh, you could easily avoid. Uh, okay, so let's talk about checking accounts. Checking account is different than a savings account because it's something that you're expected to pay bills out of. So checking accounts generally will issue you physical checks. It's going to be rare that you need a physical check, but every once in a while, there are some situations where there's no alternatives but to send out a physical check. I would say this should be your last option. So if you have the ability to pay for something with a credit card, pay it on a credit card rather than a check. If you have the ability to pay in cash, better to pay in cash than a check in some cases, not all cases. If you have the ability to pay directly through direct payment through a bill pay in a bank account, you should pay that way. If you pay with your personal check, anytime you pay someone with your personal check, they're getting the routing number and the account number on your account, which means they could use those numbers to withdraw funds from your account electronically. Now, of course, if anybody withdraws funds from your account without your permission or knowledge, you can file a claim at the bank, and the bank can try to attempt to get those funds back. But those are two very important numbers, your routing number and your bank account number. So, and checks have them uh, in full view on the surface of the check. So that's why I say try never to pay anything with a personal check. It's just too easy to have your account identity is stolen through a personal check. Now, but checking accounts are still viable because you can you could do bill pay where the banks will send out a check to or electronic payment to any of the services that you may subscribe to. So, for example, every once in a while, there's a few bills that you can't pay directly online, or that you could send a automatic bill pay check from the bank, which is a lot safer. Also, you know, where you can, so any utilities, cable bill, electric bill, water bill, um, cell phone bill, the best strategy I found is to pay for them using a credit card, because credit cards have a lot more protection and um, purchase protection, as well as the ability to the credit card company is a little bit more in a better legal stance to refute an unexpected charge that was fraudulent. Now, and you can also earn cash back and points on these credit cards. As long as you pay your credit cards off in full at the end of the month, you could utilize the rewards on these cards to enhance or lower the actual cost of some of these bills. Now, we'll talk more about that in the credit card chapter. Anyway, some savings accounts, all savings accounts will have interest that they'll pay you. Some checking accounts will also be interest bearing, but it's going to be a much lower amount of interest than a savings account. Now, the advantage of the checking account is that they're very liquid, usually have a low minimum balance, and are much more convenient. The disadvantage is some of them do have a minimum balance. Some of the accounts do have a monthly fee, and there's a lot less interest that you'll earn. So typically with a checking account, you want to have just enough money in there to cover all your monthly expenses. So I usually recommend having the average of how am I saying, 2 months worth of expenses in your checking account at all times. That way, 1 month or unexpected expenses won't lead you to be overdraft. And the rest of your money should be in a savings account, as far as being in a more liquid account that has a higher paying interest. So the savings account, the advantage is they're just as liquid as a checking account, but they earn higher interest. Um, but there could be minimum balances you need for a savings account. And sometimes you got to shop around, because some savings accounts can have very low interest. So basically, a commercial bank has some of the lowest interest in the savings account, where the credit union would pay a much higher, even sometimes double the rate of a commercial bank. Now, there is something called a money market deposit account, or an MMDA. And this is very similar to a savings account, but pays typically higher rates of interest. The money market accounts also have the ability to give you checks and debit cards for ATM. So they're considered very safe, and they have just the same privileges as a checking or a savings account. Um, Except they generally have higher minimum balances or penalties if you don't keep those higher minimum balances. The uh, the money market account is something usually most banks offer as well. They have a savings account plus a money market account, and typically the big advantage here is they pay higher interest. Now, a CD, or certificate of deposit, is a much higher interest rate you're going to get than a checking account or savings account, but your money is going to be sort of locked up for a specific period of time. So even though these certificates are very safe, they have a fixed interest rate and convenient, you do get penalized for early withdrawal. So you may have a 6-month, a 1 year, 2 year, 3 year, or 5 year certificate of deposit that will pay you a higher rate of interest. However, you won't be able to access that money until that period is over. And if you do, you can always move the money out of the certificate of deposit early, but you will be hit with a penalty, which will negate any interest you've earned, plus maybe even some of your principal. So the mutual funds also have money market accounts. So a mutual fund will offer a very safe money market account where you can park your cash in, which is gonna sometimes occur an administration fee or a management fee, but typically will also give you a higher rate of interest. So they have higher rates of interest that generally, even after the fee associated with the account, will still be a higher rate of interest than a savings account. And you could write checks on these accounts, but they might set a minimum of checks you could write a month. They're probably going to have a minimal initial investment, usually 10,000. So it's right for some people, but not right for everybody. Now, as far as asset management account, this is a more comprehensive package. So this is basically going to be a checking account, a credit card, maybe a money market account that is offered by the broker. So this is a specialized account that has multiple features within it. Now, it may be a little bit easier to coordinate your money, a little bit easier to transfer your money from the money market account to other investments, have a higher return, but typically the minimum initial deposits are a little bit higher. It might not be fully insured like a bank is. A bank is insured by the FDIC for $250,000 for each account. So there are some disadvantages of going with an asset management account. You could also buy U.S. Treasury bills or T-bills, and these are shorter term debt instruments that the government offers, usually 3 to 6 months, that are risk-free. They're exempt from state and local taxes. You still do have to pay federal taxes on them, but they generally have a low rate of return, and they might be awkward to initiate the initial balances and transfer the money. But that's why a lot of financial institutions will offer a U.S. Treasury money market, where the money market funds are invested in U.S. Treasuries. You'll get a slightly lower return because you're going to take some of the return as a fee, but still be much easier to manage and move money into and out of. There are also things called a savings bond. And savings bonds also include the Series EE and the I bonds, which are lower risk saving products issued by the treasuries. So again, these are safe, affordable. There are less taxes. I wouldn't say no taxes. Even though the slide says no taxes, you do oftentimes have to pay federal tax on these. But the way it works is if the U.S. government issues a bond, you would have to pay U.S. government tax, but you don't have to pay state and local taxes because they don't want states and localities being able to control the government by taxing their bonds. And it's the same thing for a state. If a state issues a bond, then the U.S. government can't tax it. So state bonds are federal government tax-free. And oftentimes, state tax-free as well. Those goes to municipal bonds. But anyway, the U.S. saving bonds are another vehicle to use that have semi-annual compounding. It's a lower liquidity, it's a longer maturity, but some of the hidden advantages, if you have an I bond, they'll actually compensate you for inflation, which is important in these days and times. Now, let's compare the cash management alternatives. So we can use the annual percentage yield, the APY, to easily compare options. So taxes are going to affect your real rate of return on investments. So you want to look at your after-tax return, and that's going to be your taxable return times 1 minus your marginal tax rate plus any non-taxable return. So what this basically means is let's look at our return after we take out the money we owe to the government in taxes. So if you earn interest on a savings account, on a mutual fund money market account, these are dividends that are fully taxable. So you're going to have to pay state and local tax on these funds. So that lowers your overall return. So if you had $100 dividend or interest on a savings account, you may have to pay $30 to $50 in taxes on that. Now, some deposits are federally insured, which will protect you if the bank goes out of business or becomes insolvent, which is basically the same thing. So the FDIC will protect your money at commercial banks, the NCUA will protect your money at credit unions, and the MMF will which is the money market funds. These are not insured. So the best place to have your money to be insured from any type of bankruptcy or insolvency from a financial institution is either credit union or a commercial bank or savings and loan. So let's look at some advantages and disadvantages of some of these cash management alternatives. Now, so checking or demand deposit accounts. This is something we talked about earlier. This is basically checking accounts. They're very liquid, very safe, they're insured by the government. Disadvantages is they often banks, commercial banks especially, will charge monthly fees in the checking account if you don't meet the minimum balance. So some checking accounts say you have to keep $1,000 in the checking account at all times, or some accounts might be $10,000. Now, savings accounts, these are also very liquid and they pay a higher rate of interest, but they could be subject to charges and fees as well. And the money market deposit account is going to have the highest rate of interest, um, and they are federally insured and they do have check writing privileges, but there could be, there's some drawbacks with these as well, as usually higher minimum balances in a savings or checking account. Certificates of deposit are safe, federally insured, and a great way to get higher interest rates. But there is the big disadvantage of if you need that money sooner than the time frame of the CD, there will be an early withdrawal penalty. So the money market mutual funds, these pay higher rates of interest. They're convenient. There is a limited risk because they are usually invested in short-term funds. The downside is they're not federally insured. There could be administrative fees and the minimum balance is required. Asset management accounts are something typically the very wealthy would use, which are going to kind of coordinate your money management into one account. And it's typically costly, especially if it has a financial representative that's going to be specifically tailored to working with you with the account. So there could be more fees and commissions based on this asset management account. But if you're very wealthy and you have a financial institution with a good representative, they may be able to do save you the time and effort of figuring out where's the best place to put your money, as they can sometimes manage the money for you, and that'd be more of a full service asset management account. They also have Treasury Bills and T-bonds, which are the ability to put your money into government treasuries to help fund the government, which has tax advantages but pays a lower rate of return because they're considered risk-free. And the savings bonds are other alternatives, other types of U.S. government issued bonds that have some special features, um, such as inflation protection. But again, these are very similar to Treasury bills or bonds. Okay, now let's talk about establishing and using a checking account. The things that you want to consider: the cost of the account. You want to go for a checking account that's free. Convenience. You want to pick a bank or credit union, and I suggest a credit union that's close to where you live. So if you do have to go there in person, set up an account, you may have to go there to, generally most banks or credit unions, you may have to visit 3 to 4 times a year if you're doing even if you're doing mostly everything online. So convenience is something to think about. And also safety. You want to look into, how financially strong is this credit union or financial institution? Has there been any investigations? Has there been any insolvency? So you want to really look to make sure that they have a safe operating history. Now, when you have a checking account, you have to keep track of all your transactions that are going to be involved in your checking account, because checks are not free money. So you're going to have to, at a minimum, compare your monthly statements when you register to make sure that the money you put in less the money that was taken out all ties out, all balances. You want to make sure that there's no extra money being taken out of your account. And I had that once before where suddenly uh, big chunks of money were being transferred out of my account. And when I discovered what had happened, I went to the bank, and it was a mistake that the federal government did, thinking I was looking to pay my taxes quarterly, something weird like that. And it was quickly corrected. But the moral of the story here is my advice when operating a checking account is one, keep enough money in there, at least 2 months of expenses. And then every week, you want to kind of look at your statement or look at your transactions online. And this should be done with credit cards as well, just to see, okay, run through the transactions. Do these all make sense? Do you know where this money is going or who it's being charged to? And then just make sure that your balance, um, that you have enough money is in your checking account, that in some certain cases you may have to move some money from your savings account into your checking account to cover some unexpected expenses, such as a car repair or a car insurance 6-month car insurance bill that might be larger than you expect. So you always make sure that you're up on your balances, especially if you have automatic payments coming out of your checking account to utilities and credit cards. You want to make sure that if you do any large credit card purchases, that you fund enough money in your checking account. I would say that typically I keep at least $10,000 in my checking account, which is pretty excessive. Most people could do just 2,000, but I keep 10,000 in there just to cover any large unexpected expenses that may come through. So I'm never in the overdraft position. So here's a quick checklist of your financial institutions. Make sure you understand the fees, the rates they're offering on their interests or loans, minimum balances you have to keep, and any per check charges. Some banks will charge you for checks, and some banks will give you free checks. That's an important thing to note. Usually credit unions provide you with free checks. The location, where is it located? Access to ATMs. I know my credit union has access to ATMs, but not just their ATMs, but ATMs in a credit network, which I could use credit union ATMs across the country. So sort of expands the access of credit unions. My credit union also will compensate me up to $5 a month for any fees other banks will charge me for using their ATM. So if I had to use a Chase ATM that may charge my bank $3 for me using it, or $2.50, my credit union will give that money back to me. You may also want to look at the availability of safety deposit boxes. This is where you put valuables that you don't feel comfortable storing in the house, such as diamonds, or if you had other types of documents that you wanted put in a safe place. Availability of direct deposit services, which I'd say all banks, all financial institutions have direct deposit services, and overdraft protection. Overdraft protection just says that if you're short money one month, the bank will cover it. So the bank will actually lend you the money, but then you are responsible for paying it back. And of course, they're going to charge you interest on the money they lend in overdraft situations. So what happens is your checking account runs out of money. So instead of them bouncing a check on you, they'll actually cover the check for you until you can refund your checking account. So it's a pretty useful tool. You also want to think about what type of personal attention they can give you as a customer. Do they have a customer service department you can talk to in person? Do they have financial representatives you can meet with? And that you're comfortable with every information you release to anybody, that you're comfortable releasing that information or giving them details on your account. And that finally, you want to know, are they federally are your deposits federally insured? Which there'll be a sign right on the bank, usually FDIC, right away to let you know. So how can you reduce or eliminate overdraft fees? So if your account does go overdraft and you don't have an overdraft protection, they can charge you a big fee. So you can also opt out of the overdraft protection programs, which means that your ATM card might be declined if you don't have enough money. However, this means that you won't be charged any transaction fees. So if your account does go into overdraft, you know the rules of your particular bank and how they charge fees in that structure. Linking your checking account to your savings account is a good way that if your checking account becomes overdrawn, your bank will automatically transfer funds from your savings into your checking account to cover any of these anytime you're lacking funds. But some banks will charge you a transfer fee if they have to do this. So that's another thing. And usually when you open a bank account, they'll give you a list of all the fees that you should check into. You could also ask your bank if you're eligible for a line of credit, a link to a credit card, overdraft protection, or even a line of credit linked to your home. So this is just something that you can set up early, and if you happen to need the money, you can access one of these lines of credits. Okay, so you could also want to track your balances carefully to make sure that you're not going to be in trouble of a low balance. You could all these usually credit cards and banks and financial institutions will let you set up different levels of alerts or notifications when you're at risk of overdrafting or a transaction has been made in your account. So they could send these notifications to email or through your phone, and you can get information as soon as anything is electronically transferred in or out of your account. And make sure you shop around. It's easy to do with websites. Just go to local banks, their websites, and see what they're offering, how they stack up. Um, you can always request, if it's not on the website, you can always request the list of fees on the accounts. You could sit down and talk with a representative at the bank. Um, and you want to know, what important thing is, are ATM usage free? Do they usually, most banks will have free ATMs for their ATMs, or what do they charge you if you have to access somebody else's ATM from another bank? These are all things that you should know about. Now this is just something that's in the textbook, which is a worksheet for balancing your checkbook, which, to be honest, I don't I don't really keep a running balance on my checking account. I just every week I routinely check the transfers in and out of the account and just make sure everything makes sense as far as what's going in the account, what's coming out of the account. But this is just sort of an overview if you wanted to have a more formal process for balancing your checking account, which just basically means that all the checks you've written have been cashed and withdrawn from your account, that you have a better idea of what your balance is. And basically, you have your ending balance from your bank for the month, which becomes your beginning balance. You want to look at any deposits you make into the account, less any outstanding checks and charges, and then this is your adjusted balance. So it's pretty simple. Now, when we talk about checks, there are different types of checks. So you have your personal check, which comes from your checkbook. Very simple thing to talk about. But there are sometimes they may request other types of checks that you might want to utilize. For example, it might be requested that you get a cashier's check. So this is a check that's drawn on the bank's account. So it's not from your checking account. These are checks that is almost like the bank writing a check. So it's a check from a bank, and it's a check that's not going to bounce. So these checks, cashier's check, is just a little bit more secure, and there's no risk of the person accepting a check that is going to really bounce. But banks are going to charge you for the right for them to cut you a cashier's check. And this is typically, if you're paying for something by check, they may not want to accept your personal check. They may request for a cashier's check. Now, another level, they can go up a level and actually ask for a certified check. So this is a personal check that's been certified as being good by the financial institution. So if you want a check to be certified, the bank has to first make sure that you have the funds and the individual account are covered by the check, and the bank immediately freezes those funds to make sure that they're available for whoever's going to cash the check. Now, there's also something called a money order. So a money order is something, it's sort of like a cashier's check you don't get at a bank. You get it at a post office, at a 7-Eleven, and a money order is basically cash in the form of a check that is also going to be free of bouncing. So some places may require a money order from a reputable institution as payment. Now, the drawback of a certified check or a money order is that it gets difficult if you lose these things, because you're going to have to prove to the person who issued it that the check has actually been destroyed or lost before they'll reissue those funds back to you. So you have to treat them like cash. If they're lost or lost in the mail, you lose out on that money. So you want to be careful. Always ask about what happens if I lose this or it gets destroyed. What can I do? Now, there's also something called traveler's checks, which are similar to a cashier's check, except they are more like cash. They come in denominations 20, 50, $100, and large financial institutions will issue these traveler checks, um, and they use when you travel. So if they're lost or stolen, they can be replaced quickly without a charge. And it's something that most of us don't do. Most of us don't use traveler's checks because the reason why is when you go somewhere and you pay with a traveler's check, a lot of businesses don't see them very often. They don't know what to do with them, especially internationally. So even though it's a good idea to have checks a little bit more protection for you, and the person that's receiving them, they just really haven't been that popular, uh, uh, been used enough in circulation that most financial, um, even though they're offered by most financial institutions, a lot of retailers and businesses may not be sure what to do with them, and may be reluctant to even accept them. Okay, now to take a step back for a second, if we talk about love and money, um, should you keep your finances separate in a relationship, or should you combine your finances, meaning having a joint checking account? So this is something that I would say to keep your finances as separate as possible for as long as possible until it really makes financial sense to merge your accounts. Say if you're married or you're in a situation where it just makes sense that the account should be merged into one account for getting better advantages, like having higher deposits through, some banks, the more you have deposited, the higher interest rate they'll give you. um, and arguments about money is one of the biggest contributors to divorce, so just keep that in mind. Anyway, EFT, electronic funds transfer. So transferring money, um, fully electronically. And this is something that's never been easier because not only do we have fund transfers at banks where you can use your bank account to transfer funds among other people, you also have apps like uh, Venmo, Cash App, Zelle. These are other electronic transferring apps where you can load and transfer money back and forth with people. So the advantage for most of these accounts is that transactions will take place immediately. You don't have to worry about carrying cash or writing a check, and you can pay all kinds of bills. And if you have Venmo, you realize it's a very easy way to, if you're at a restaurant, or if you're buying something with other people, it's an easy way that one person pays and then you can just compensate them by sending money over to them through Venmo, like splitting a check at a restaurant. So electronic fund transfers can also be used to um, borrow money from your parents or pay your rent, or a lot of different uses for transferring it directly. um, so it's something that's a field of finance that's growing quickly with all sorts of new financial apps in this space of transferring money. And what's nice about things like Venmo, you're transferring it without a fee. There's also PayPal, which PayPal has its own electronic fund transfers available too. So some common examples: ATMs are an easy way to transfer money between your accounts. Um, Debit card transactions are an easy way to transfer money from your checking account and onto a card and spend it, or use your card. It's like a credit card, but it's directly linked to your checking account. Um, you can have, when they say stored value cards, they really mean like gift cards, which I don't think is a great way to move money around. Now, the ATMs, or the automatic teller machines, this is something we're all familiar with. And the ATMs have gotten smarter and smarter over time. So basically, if you go to a Chase ATM, there's so many things that you could do with the Chase ATM: deposit money, withdraw money, pay bills, transfer funds. Uh, some of them you can take out a loan. You can even designate what type of bills you want to have withdrawn. So it's really increased in the functionality of what these automated tellers can do. It's no longer just withdrawing money. It's so many other features and functions they can do as well. Now, so it's very convenient. Sometimes they can be costly. So you want to make sure that you have a bank account that gives you access to unlimited free ATM transactions owned by your bank, and a minimal amount of cost if you use an out-of-network ATM. Now, the thing about ATMs you have to be careful of, there's two big things. One, if you're taking money out in a location that that might have a more high crime location, that's a target for being robbed. Also, there's a lot of electronic theft where they put a fake covering over the ATM. So when you put your card in, there's a fake covering recording your account numbers. And later the cyber criminal comes back, they take off the covering, and now they have all this credit card information. Uh, ATMs, so there is some risk to using ATMs. There's also, a risk of using your debit card or your credit cards. Anytime you use your debit card or credit card, people can get your information as well. One of the biggest areas of credit card theft was at restaurants and gas stations, because if you have full service, you give your credit card to the person who pumped your gas, they can now easily take a picture of your credit card and have all your numbers and security codes. Same thing with a restaurant. When you pay with credit card at the restaurant, the server leaves with your credit card. You don't know what they're doing with their credit card. That's why in many countries, especially in Europe, the credit card never leaves your hand. The server comes over with a machine. They charge your credit card right there at the table. They never get to hold your card in your hand. So I'd say if you have a credit card or a debit card, never let anybody physically have it. Always be the one swiping it or charging it yourself, so no one can easily take a picture or copy of the numbers off of it to protect yourself from fraud and theft. Here's a quick list for some security at ATMs. So treat your ATM card like cash and keep your card in a safe place. Never write your PIN number on your card. It pains me to have to say that, but there's so many people I've run into that actually write their PIN number on their card. Keep the PIN a secret. Don't tell it to anybody. Memorize your PIN code. You should never really write it down anywhere, or especially on the card. Never tell anyone what your PIN code is. Or let anybody else enter the code, or let anybody else watch you enter the code. That's a common way of getting robbed is someone might be behind you in the supermarket or at the ATM. They see what code you enter in, and then they try to get your ATM card from you, and then they go withdraw the maximum allowed on the card. If you lose your card, report it as quickly as possible. That's why it's good to have a record of all your credit card numbers, so that way when you call it in lost, you're able to tell them, here is the account number. And a lot of times you can find this out online on the internet or on your statement. I know that when I traveled, I've actually taken pictures of my credit cards, so I have them on my phone. Hopefully my phone is secure enough. That way, if anything is lost, I immediately have these credit card numbers so I can cancel, and the phone number in back of the credit card to know who to call to cancel them. Always check your receipts against your monthly statements to make sure there's no ATM fraud, that there's no should always double check whatever you charge is the proper charge being hitting your account. Make sure you always check your surroundings before you use an ATM machine. Make sure that it's in a safe, comfortable place you're used to, hopefully it's during the day or you have a friend with you. Make sure that you don't, when you type your numbers in, you obscure the view of anybody. They can't see what your PIN is. Minimize the time spent by having a card ready and you're ready to go. You get up there and use it quickly, and just make sure there's nobody suspicious coming and going or hanging out around where the ATM is. Now, if you do make an ATM transaction and someone's following you to your car, and make sure you try to go to a heavily populated area, a well-lit area, or into a store somewhere where they're not likely to follow you. And the same thing if you're using a drive-up ATM. Sometimes you want to make sure that you keep the engine running, your door is locked, and then when you get your money out of the window, just make sure there's no one lurking who's going to jump out and try to grab it out of your hands, which has happened before. Now let's talk about debit cards. So a debit card is basically acts like a credit card, but it's connected to your savings account or checking account, most likely your checking account. And this is a card that you could use. It looks and acts just like a credit card, but it's also be able to use at ATMs to access both your checking and savings account. Now, what's good about a debit card is that you can withdraw cash from an ATM. You can't If you withdraw cash using a credit card from ATM, there's substantial fees and interest charged to your account if you use a credit card to withdraw cash. That's why it's always good to have a debit card to withdraw cash uh, at the lowest possible cost, usually free. And that's the biggest advantage of a debit card, is that you get to access ATMs and withdraw cash when you need it. I would say that I would not use my debit card for daily transactions, because oftentimes a lot of debit um, credit and debit card data can be easily stolen, and sometimes it's not your fault. You just Home Depot, Target, so many retailers had their credit card information stolen from them, and now other people have your credit card information. Now, it's not so bad if they have your credit card information, because you can easily refute any of the charges, and the credit card company will move quickly to take care of, issue a new credit card and refund any fraudulent charges. But with a debit card, it's much harder. So you don't really want anybody to have your information in your debit card. So I'd say when it comes to debit cards, use them only at your local bank, at your the ATM machine inside your bank, which is less likely to be tampered with, and don't use it that frequently. Don't carry it around to pay for everyday transactions, because the less you use your debit card, the less chance that it could be um, that somebody could get access to those numbers either visually or electronically. Okay, so well, let's just go back to smart cards. These, I think of them more like sort of like a gift card. Um, they, it's like a debit card, but this term smart cards is something used loosely to describe a number of different situations. Um, Now, think of the strip on the back of your credit or debit card. That's a magnetic strip where the data is stored. Some cards also have chips on them. Most cards today now have chips on them due to all of the credit card theft that happened through the magnetic strips. So the chip is an extra layer of security. Um, the This is, something like your student ID card at school. So you have your student ID card, which you could load money onto to use to buy food at school. That's an idea of a smart card. It's not really a debit card. It's not really a credit card, but it's a card you can load money on and reload money on. It could be like a Starbucks card. So these are just not really something that you use too often. They're kind of, that's why I say they're more like gift cards, but probably your school ID may also function like a smart card where you could load money onto it. And that's kind of an example of a smart card. Now, prepaid debit or gift card, sometimes you can get a prepaid debit card or gift card, and these prepaid cards, they look just like credit cards. They could be used, just to use them as a credit card, and then you reload them with more money when you're ready to. So usually they're given as gift. Usually they're more expensive. So if you buy a $50 American Express gift card, it's going to come maybe with a $5 fee. So you have to spend $55 to buy a $50 gift card, and that's usually the activation fee. There can be maintenance fees on these, ATM transaction fees, but typically these prepaid gift cards, they're nice as gifts. Um, some people use them as an extra level of security. So if you have to go to, say you want to buy some stuff from websites that you're afraid to give them your real credit card or debit card numbers, that's where these gift cards or these gift credit cards may come in handy, where you get American Express or a Visa gift card. Then you could use them to sign up for subscriptions or sign up for websites that you're not so confident in. And once the money runs out in that card, they can't charge you again or overcharge you for it. So it's a way of getting a little extra level of protection in places where you're not so sure about charging the card again. Okay. Now, what if there's a mistake? Um, so if there's a mistake and you see that there's an error on your checking account, your savings account, or your credit card or your debit card, this can happen. Um, Don't freak out. Sometimes it could be a computer error. Hopefully, it's the type of error you wake up and there's an extra $1 million in your account. But these happen. It can happen at a bank when you come to a teller and you make a transaction. It can happen at an ATM. So if this does happen, whether it's in your favor or not in your favor, you want to report it immediately. Call the bank, visit the bank, send the bank an email, and by law, you want to write within 60 days of receiving your statement on any charges you find suspicious. You can certainly, on your credit card, you can call the credit card company, and if they agree with you, they could charge back the charge to the original merchant. If it's a problem, like I said, I had somebody directly transferring money out of my account, uh, and the bank can investigate and get those funds back for you. So it's always something. That's why you want to keep track of things. You don't want it to expire after 60 days and try to work on it. You want to work on it the sooner you start working on it, as when you first notice it or it first occurs, the more easier it'll be to clear up or fix. Generally, 9 out of 10 times, the charge on your account that you think is fraudulent or you think that is not correct is correct. You may have forgotten that you charged it. It may be charged under a weird name, something you're not familiar with. It may have been charged by a spouse or a child that you share the account with. So this often happens, say, for students who are in college. They might be using a credit card that is shared with their parents, and they're charging different books or fees associated with the different courses. And there's maybe something a parent doesn't recognize, and they do a chargeback on it, and it's just that's why you want to make sure before you do report any of these mistakes that you're very confident that this is indeed a legitimate mistake that has occurred. Okay, so let's just review here. What did we talk about so far this chapter? We talked about cash management, automatic savings, um, choosing different types of accounts. We talked about various cash management alternatives. We talked about commercial banks, credit unions. We talked about rates of return, safety in accounts, the different aspects of checking accounts, different aspects of electronic funds being transferred. So these are all tools that you could use to help you manage your money. So remember the goal here. The goal here is you want to reduce all your fees, hopefully to zero. For example, I've gotten it down to a point where I pay zero money in fees. I don't pay fees for anything. Everything is covered by the credit union, or if it does have a fee that I can't have covered, I just try to do something different rather than do the transaction that's going to come with a fee. Um, Look for an alternative. You also always want to make sure that you're getting the lowest rate of interest on your credit cards, that you're getting the highest rate of interest on your savings and checking accounts, that you're not paying any maintenance costs, that you understand what your minimum balances are required, you understand what your overdraft protections are, how you could be charged overdraft fees. So these are all things that if you manage your cash properly, you should be able to manage in a way that you're paying zero fees on your liquid assets, and that your liquid assets are working for you as far as you're keeping in the bare minimum that you need. One of the worst things to do is keep too much money in a liquid account where you're missing other opportunities to earn a higher rates of interest in the financial markets, something we'll talk about in later chapters. Okay, thank you for your time today, and I hope you found this helpful.